This isn't a Wall Street story. It's the story of how a world-famous ballroom dancer, totally cut off from the noise of the financial world, turned about $25,000 into over $2 million. What was his secret? It wasn't expert analysis. It wasn't breaking news. He had something way more powerful, a psychological system he built in total isolation. It's proof that the greatest advantage in trading isn't what you know, but what you can force yourself to ignore. Our story starts in the 1950s with Nicholas Darvas, a Hungarian refugee who, with his half-sister, became one of the most famous and highest-paid dance acts in the world. He was an artist living a life of globe-trotting glamour, a world away from the frantic trading floors of New York. His entry into the stock market was a complete accident. A nightclub in Toronto, short on cash for a performance, paid him with shares in a Canadian mining company. Darvas took the shares, promptly forgot about them, and was shocked to discover, months later, that they had skyrocketed in value. That one lucky break lit a fire in him. If money could grow this easily by accident, what could happen if he actually tried? Fueled by that initial rush, Darvas dove headfirst into the market and, like so many beginners, failed spectacularly. He chased hot tips, he bought stocks based on flashy headlines, he listened to rumors from so-called experts. He basically wrote the book on what not to do. He found himself overtrading, sometimes making 20 trades a day, and his broker was making more in commissions than he was in profits. He knew the sting of buying a sure thing, only to watch it collapse. In the agony of selling a rising stock for a tiny gain, only to see it climb and climb without him. He was losing money, trapped in a cycle of emotional decisions, getting more and more frustrated with the useless chatter. It was during this string of painful losses that he had a breakthrough. He realized the insider gossip wasn't an advantage. It was a trap. It was just noise, designed to confuse amateurs while the pros quietly took their money. He knew then that to succeed, you had to get away from all of it. While touring the world, from Paris to Calcutta, Darvas made a decision that would define his entire career. He embraced total isolation. He didn't really have a choice, but he turned this limitation into his greatest weapon. In an age before the internet, his only link to the market was week-old, air-mailed copies of Barron's magazine and pricey, cryptic telegrams he sent to his broker in New York. This primitive setup forced him into a state of discipline. Data was always late. Orders had a built-in delay. He couldn't panic sell during a midday dip, because by the time he heard about it, the day was long over. He couldn't chase hot tips, because they were stale by the time they reached him in some far-flung hotel. He was completely immune to the daily rumors and emotional panic that infected Wall Street. All he had were the numbers, price and volume. This forced simplicity became the foundation of his mental fortress. He was no longer a frantic player, but a detached observer, studying the market's patterns like a dancer studies choreography. He realized success didn't come from reacting to every little market twitch, but from a rigid system that filtered out emotion completely. The isolation wasn't a bug. It was the entire feature. From his fortress of solitude, Darvas developed his legendary box theory. This wasn't some complex algorithm. It was a simple, elegant way to understand how stocks move, and, more importantly, how to control his own behavior. He noticed stocks don't move in a straight line. They move in steps, pausing in a price range before making their next leap. He started to visualize these ranges as boxes. Here's how it worked. First, he only looked for stocks hitting new 52-week highs, stocks that already had powerful upward momentum and public excitement. Next, he'd draw an imaginary box around the stock's recent price range. The top of the box was the recent high. The bottom was the recent low. As long as the stock traded inside this box, he did absolutely nothing. He just watched and waited. This was his psychological shield. Inside the box is where emotions run wild, where traders get that itch to jump in or out. Darvas refused to play that game. His rules were ironclad. If a stock broke out of the top of the box on high volume, it signaled that the upward trend was real and continuing. He'd send a telegram, buy. He would then immediately place a stop-loss order just below the top of that box, making sure that if he was wrong, his losses were tiny. As he famously put it, he wanted to play a game where if he bet $100, he could get out for 98 if he lost. If the stock fell below the bottom of the box, the trend was broken. He would sell immediately. No hesitation. No second guessing. This ruthless discipline in cutting losses was the key to his entire success. If you're finding this story about discipline and psychological control inspiring, take a moment to like this video and subscribe for more deep dives into the minds of legendary traders. Armed with his box theory, Darvas's fortunes completely turned around. The method was systematic, repeatable, and most importantly, it kept his ego out of his wallet. When a stock he owned kept climbing and formed a new higher box, he didn't sell to lock in a quick profit. He often did the exact opposite. He used a technique called pyramiding, buying more shares as the stock broke out of each new box, using his paper profits to fund even bigger positions. All the while, he trailed his stop-loss order up, moving it to the floor of the newest box to protect his growing gains. His biggest wins came from this incredible patience. He just let his winners run, holding on as they jumped from box to box, sometimes for months. Between 1957 and 1959, this method allowed him to turn his initial stake into an incredible $2.25 million, a feat so amazing it landed him in Time magazine. One of his most legendary trades was a company called E.L. Bruce. He bought in as it broke out of a box, and as it exploded higher, he just kept buying more. The stock moved so violently that the New York Stock Exchange actually halted trading. While most people would have panicked, Darvas, isolated in a hotel room in Paris, held his nerve. When the stock resumed trading, it got even higher, and he eventually sold near the top, cementing a massive profit. This was the power of his system. It let him ride monumental trends that fear would have shaken anyone else out of. Now you're probably thinking, that's a great story from the 50s, but how does this apply to today's chaotic, high-speed markets? The answer is that while technology has changed, human psychology hasn't. The same emotional traps of fear, greed, and FOMO that Darvas escaped are more powerful than ever in our hyper-connected world. You can build your own version of Darvas's mental fortress, simulate his Telegram workflow. Start by turning off the constant notifications, stop watching the minute-by-minute swings of your portfolio. Instead, curate your information. Focus only on what mattered to him, price and volume. Engineer delays into your decision-making. Check your stocks once a day after the market closes. Like you're reading the evening paper. Before you place a trade, write down your reasons and your rules, your box, and wait 24 hours. This cooling off period is death to impulsive moves. Treat yourself like a detached outside observer, not a frantic participant glued to the screen. Modern tools can even sharpen his method. You can use indicators like the average true range, or ATR, to scientifically define the size of your boxes, filtering out noise and volatile assets. You can apply modern risk management, risking only a tiny fraction of your capital on any single trade. But the core principle is timeless. Create a rules-based system and execute it with unshakable discipline. The deepest lesson from Nicholas Darvas isn't really about boxes. It's about the human mind. His journey proved that market mastery doesn't come from more information or more screens. It comes from less noise, less opinion, less emotion. His greatest financial crisis came not during a market crash, but when he returned to New York, abandoned his isolated system and tried trading from a broker's office. Surrounded by the noise and energy, his discipline instantly crumbled, and he started losing money again. He had to flee back to his life on the road, back to his telegrams to get his edge back. Nicholas Darvas, the world-famous dancer, became a trading legend not because he was a financial genius, but because he was a master of his own psychology. He built a fortress around his mind and proved that sometimes the greatest advantage you can have is to simply be left alone. He showed the world you don't need to be a Wall Street insider to win. You just need a system, the courage to follow it, and the wisdom to ignore everything else. So, what do you think? Could a strategy of disciplined isolation still beat today's high-speed markets? Let me know your thoughts in the comments below.